So let's move on to the other global stories as well. The macro data that the markets will be eyeing today, the US Q3 GDP, that has been revised lower to 4.9%. Now that's slightly below that 5.2% in the second estimate, but it matched the 4.9% which was initially reported in the advance estimate. Now the reading down from the second estimate, increase of 2% and lower than the rise of 5.1% which was seen by the economist. Now the real GDP that rose 2.1% in the second quarter.
Athletic apparel and footwear giant Nike Q2 results beat analysts' expectations, but the company tempered expectations as they warn of a softer second half outlook for revenue as it looks to streamline operations, targeting up to $2 billion of cost cuts over 3 years. The share also tanked around 10% during the after-trading hours.
Let's focus on what's happening in the auto sector. Now, after Toyota, auto giant Honda has also joined the bid in recalling vehicle units. Now, the company is recalling around 4.5 million vehicles worldwide over risk of pump failure. The recall includes 2.54 million vehicles in the United States. Now, remember, the automaker had previously recalled several units over the same issue over the last 3 years.
With 158 vessels carrying approximately $105 billion in ocean freight being diverted away from the Red Sea amid the risk of continuing Houthis attacks, cargo prices are soaring. Just when COVID supply chain inflation seemed vanquished, ocean freight rates are increasing 40% on some trade routes and container prices reaching $10,000.
And as I pointed earlier about the Red Sea issue, many ocean carriers have stopped their ships from using the Red Sea following the projectile attacks from the Yemen-based Houthi militia. Now, the rerouting that has disrupted the global trade, and that is being seen as a key inflation risk. Now, to get more clarity on what's the impact, how this supply disruption, it's impacting the global trade, Snehi Shah is joining in with this detailed report on this. Snehi, over to you.
Well, on the 15th of December, the world's second largest container shipping company, Maersk, announced that it will suspend all container shipments through the Red Sea and reroute its vessels around South Africa's Cape of Good Hope in response to the attacks on its vessels in the Red Sea. Following this announcement, major players in this space like MSC, CMA CGM, Hapag-Lloyd and others have also followed suit, and Chinese and Taiwanese container shipping companies are considering similar measures, and there have been announcements about temporarily stopping accepting Israel cargo. Now, why are these companies looking to reroute, and what's the trouble that's brewing in the Red Sea? Iran-backed Houthi militants in Yemen attacked commercial vessels in the Red Sea to show support for the Palestinian militant group Hamas. The Houthi group has reportedly vowed to continue operations targeting Israeli ships or vessels headed to the Israeli ports. Now, what's the impact of these attacks? Analysts at BOFA say that around 28% of the world container trade and 12.3% of the crude tankers use the Suez Canal or the Red Sea route. That map will be on the screen shortly. Alternate routing via the Cape of Good Hope would add an average of 30% to journey times for containers, or about 22 days more on a round-trip basis. That is indicated by the red line on the map that shows an entire rerouting from the Cape of Good Hope all the way to Europe. Now, if all companies were to adopt such measures, this would cut shipping capacity on routes from Asia to Europe by roughly 30%. The Suez Canal is the quickest sea route between Asia and Europe and one of the key choke points for global trade. Recall the supply chain snarls caused when the Ever Given container ship got stuck in the Suez Canal for just 6 days in 2021, but disrupted around $9.6 billion worth of world trade per day. For businesses, the immediate impact will be felt via higher trading costs, like higher insurance premiums and delays in shipments given diverted vessels. This situation is likely to cause shippers to once again become mindful of supply chain disruptions like those seen in the past years, and analysts think that this is likely to put upward pressure not just on spot freight rates, but also on the yearly contract rates. Analysts at Nomura believe it would not be particularly surprising for spot rates on this route to double or even quadruple. Now, while the impact of these attacks is believed to be short-term in nature, we have seen a spike in crude oil prices over the last few days. What's the potential impact on India then? One of the biggest impacts of the blockage of trade or use of alternative routes is usually an increase in the freight rates as routes get longer and volumes reduce. Now, while this is beneficial to shipping companies, increasing costs of transportation and delays in shipments could have a much larger impact. Overall logistic costs are bound to rise, which Indian exporters and importers may find difficult to pass on to end users. As of now, it is too early to say and talk about the impact of this development on India's earnings story. However, we have seen a few shipping stocks like SCI and GE Shipping rise over the last few days, and some of the import-dependent sectors that could be impacted include textiles, oil and gas, chemicals, some capital good companies, metals, as well as pharma. So keep an eye out for all of these sectors.
Well, thanks, Nehi, for that update.